Most people spend $2 a day without thinking, not realizing small daily habits quietly shape their long-term financial future. I am Alex, and today I will show you why tiny amounts can grow over time to create real, meaningful income. Before we begin, gently tap like if you want more calm, clear, stress-free videos about understanding money effectively. Leave a comment telling me where you are watching from, and join the conversation with people who also want financial clarity. Subscribe if you want to see future videos that explain finance simply, without complicated jargon, pressure, or unrealistic hype. Tultings. This video is designed for everyday people, not finance experts, so anyone can understand and apply the ideas immediately. Imagine small purchases like coffee, snacks, delivery fees, or subscriptions, quietly taking a few dollars from your pocket each day. Most people forget these expenses because each one feels too small to matter, even though they repeat over years. But money responds to consistency and time, not to how significant it feels in the moment or how much we notice it. $2 a day may seem invisible, yet when compounded over decades, it quietly accumulates into a surprisingly large sum. 18. The real power comes from understanding that slow changes, repeated consistently, eventually become unstoppable and meaningful. Today, I want to show you how this small daily habit can eventually produce over $1,000 of income each month. I will break down the numbers, the strategy, and why patience and compounding are far more important than quick gains. You do not need a huge starting amount, perfect timing, or special knowledge to start making money work for you. The key is consistency and understanding how dividends and reinvestment slowly create growth that accelerates over time. Key start. By the end of this video, you will see why $2 a day is not insignificant. It is the foundation of long-term wealth. This is not about instant riches or risky strategies that could disappear overnight, but steady growth that compounds silently. Most importantly, I want you to feel empowered, not overwhelmed, by the fact that small actions really do matter. And if you enjoy this approach, gently like this video to let more people discover simple, effective ways to improve their finances. Comment below where you are watching from, subscribe, and keep watching to see exactly how small daily habits create huge long-term rewards. Now that you understand why small daily amounts matter, let's explore how they can be transformed into predictable income over time. The secret lies in dividends, which are portions of a company's profits shared with shareholders like you for simply owning stock. Dividends might sound complicated, but in reality, they are like receiving regular rent payments from the companies you invest in. Some companies reinvest all earnings into growth, while others share a steady slice of their profits as dividends you can count on. One key metric is dividend yield, which tells you how much income you earn annually relative to the stock price you own. Toisawo. For example, a 3% dividend yield means every $10,000 invested pays about $300 each year. Dividend investing creates stability because your income does not depend on constantly guessing when stock prices will rise or fall. This predictability allows you to plan ahead, stay focused, and feel in control of your long-term financial goals and decisions. Unlike growth stocks, where you rely on selling shares at the right moment, dividends arrive consistently, giving you real confidence. When dividends are reinvested, your share count grows automatically, compounding your income without requiring additional large investments. Therefore, even small amounts start producing noticeable results over time, gradually turning a few dollars into hundreds and eventually thousands. One of the most important advantages of dividend investing is how it reduces stress during market volatility, keeping your income stable. When markets move up or down, dividend payments typically continue uninterrupted, providing a steady foundation for your portfolio growth. Predictability matters because it allows you to avoid panic selling and helps you maintain a consistent long-term investing mindset. You do not need to time the market perfectly. Instead, focus on building a habit of contributing and reinvesting regularly. 3Z. This long-term strategy relies on patience, consistency, and the power of compounding, rather than chasing short-term gains or hype. Over time, companies tend to increase dividends, which grows your income without adding any extra money beyond your initial contributions. Even starting with just a couple of dollars a day, regular contributions multiplied by compounding eventually become substantial over decades. The earlier you start, the more powerful compounding becomes, turning small, consistent investments into meaningful passive income streams. And the beauty is that you do not need to be wealthy or have insider knowledge to make this strategy work consistently. Now let's look at the numbers behind earning $1,000 per month from dividends without relying on luck or timing. To reach $1,000 monthly, we need $12,000 annually, which becomes the foundation for your investment strategy. The first step is understanding dividend yield, which measures how much income a stock generates based on its current price. For example, a 3% yield on $10,000 invested produces approximately $300 in income each year. But yield alone does not tell the full story, because the growth of dividends over time dramatically increases total income. A company increasing dividends 10% per year grows your income automatically without requiring additional investments on your part. Reinvesting dividends compounds your portfolio further, increasing your share count and accelerating future payouts consistently over decades. Small contributions made daily, even just $2, add up surprisingly fast when combined with consistent dividend growth and reinvestment. Over time, those incremental investments start generating meaningful income, showing the true power of patience and compounding combined. Diversification is key, because relying on a single stock exposes you to risk and can disrupt your long-term dividend growth. Spreading investments across multiple high-quality dividend-paying companies smooths returns and reduces the likelihood of significant setbacks. Each stock in your portfolio should serve a purpose: stability, reliable income, or long-term appreciation through dividend increases. One of the simplest ways to start is using broad market dividend ETFs that provide instant diversification and consistent payouts. Vanguard's dividend-focused funds, for example, combine hundreds of companies with stable dividends and long-term growth potential. Another approach is selecting individual companies with strong cash flow, low debt, and a history of increasing dividends reliably. Monitoring payout ratios and coverage ratios helps ensure the companies you choose can sustain their dividend payments over time. Free cash flow and debt levels are equally important, as they determine the company's ability to continue paying and growing dividends safely. Extremely high yields, often above 5 or 6%, may indicate underlying problems, so careful evaluation is essential for safety. Understanding these metrics allows you to select dividend payers that provide stable, growing income without unnecessary risk. By combining small daily contributions, reinvestment, and careful stock selection, you lay the foundation for predictable monthly dividend income. Once you understand yield and metrics, the next step is focusing on dividend growth and how it accelerates your long-term income. Companies that consistently increase dividends year after year automatically raise your income without requiring you to buy additional shares manually. Reinvesting those dividends compounds your portfolio, gradually increasing both your share count and future dividend payouts significantly over decades. Even modest growth rates, around 6 to 10% annually, become incredibly powerful when combined with time and consistency in investing. Patience is critical because the largest impact of dividend growth and reinvestment usually appears after several years or even decades. Small daily contributions, like $2, may feel trivial at first, but compounding ensures their impact grows exponentially over time. This is why starting early is so important. Every day of contribution increases the power of compounding significantly in the long run. Let's imagine investing just $2 every day without any initial lump sum and letting it compound for years. After the first year, your contributions would total approximately $730, a foundation for future growth. 10 years later, those consistent contributions could grow to more than $15,000, assuming average dividend growth and reinvestment. At the 20-year mark, the portfolio might reach over $80,000, demonstrating the true magic of consistent investing and compounding. By 30 years, this small daily habit could result in a portfolio exceeding $400,000, generating substantial monthly income. The portfolio would then provide roughly $18,000 per year in dividends, surpassing the initial goal of $1,000 monthly. Much of the growth comes from share price appreciation, but reinvested dividends account for a significant portion of the total return as well. This example demonstrates how small, consistent actions combined with patience can produce results far beyond initial expectations. Diversifying your investments is equally important to protect against single stock risks or unexpected industry downturns. By spreading your contributions across several high-quality dividend-paying companies, you smooth returns and reduce the chance of large setbacks. Each stock in your portfolio should contribute to stability, consistent dividends, or long-term appreciation to maximize growth potential. Monitoring metrics like payout ratio, dividend coverage, cash flow, and debt ensures the companies can sustain and grow dividends safely. Understanding these fundamentals lets you select companies that provide reliable, growing dividend income over decades without unnecessary risk. Now that you understand dividend basics and compounding, let's explore the portfolio that turns a small daily habit into meaningful monthly income. A carefully selected mix of high-quality dividend stocks and ETFs provides stability, growth, and reliable income simultaneously for long-term success. The first component is a broad market dividend ETF, which offers exposure to hundreds of companies with consistent payouts and strong fundamentals. Vanguard's S&P 500 Dividend ETF, for example, combines stability, predictable dividends, and long-term appreciation for the foundation of the portfolio. Its current dividend yield is modest, but historical data shows consistent growth, making it an ideal anchor for long-term investing. Next, adding a dividend-focused ETF provides stronger income while maintaining high-quality companies with reliable cash flows and fundamentals. This fund focuses on companies with stable earnings and growing dividends, which smooths income and reduces risk from market fluctuations. Individual stocks can be added to provide accelerated dividend growth, giving your portfolio long-term momentum alongside broad market stability. Look for companies with solid 10-year dividend growth, strong earnings, and manageable debt levels to ensure reliable payouts over decades. Financial sector stocks often provide predictable dividends and growth, contributing to a balanced portfolio without relying solely on one industry. Real estate investment trusts, especially those focused on warehouses or logistics, add a different type of income backed by tangible, long-term demand. Each investment serves a purpose. Some anchor stability, some drive income, and some accelerate growth through compounding and reinvestment. Diversification ensures that if one stock or sector underperforms, the others continue producing income, reducing stress and emotional decisions. Calculating the portfolio's average dividend yield helps estimate monthly income and project long-term growth with more precision. By averaging yields across each holding, you can understand what your portfolio generates now while factoring in growth and reinvestment. Historical dividend growth rates indicate how much your income could rise automatically each year without adding new capital manually. Share price appreciation further increases total portfolio value, contributing to wealth accumulation alongside consistent dividend payouts. Tracking metrics like payout ratio, dividend coverage, and cash flow ensures your selections remain sustainable and continue producing predictable income. The combination of ETFs, dividend growth stocks, and careful monitoring forms the foundation of a portfolio capable of generating $1,000 monthly. This portfolio demonstrates that small daily habits, compounded intelligently over decades, can produce substantial passive income for anyone. Let's break down the portfolio in detail, showing exactly how each holding contributes to stability, growth, and consistent dividend income. The first holding provides broad market stability, exposing you to hundreds of top U.S. companies with steady dividends and long-term appreciation. Its dividend yield is modest at approximately 1%, but consistent annual growth adds reliable income over time to your portfolio. Historical data shows this fund's dividends have increased about 6% per year, illustrating the power of steady, compounding growth. The second holding focuses on stronger income, targeting companies with high-quality fundamentals and reliable cash flows to generate meaningful dividends. Queet. Its yield sits around 3%, and 10-year growth averages near 10%, providing dependable income while supporting long-term portfolio expansion. Adding a high-growth dividend stock accelerates your portfolio, offering above-average increases in both dividends and share price over time. This stock has consistently grown dividends by over 20% annually, illustrating how compounding multiplies income even from small investments. Financial sector stocks are included to provide steady payouts backed by consistent earnings and solid dividend growth over multiple years. Yield averages around 4%, with long-term appreciation adding both income and value to the total portfolio consistently. Real estate stocks, especially in logistics and warehouse sectors, diversify income with tangible assets and steady long-term demand for dividends. Yields of roughly 3%, combined with 10-year dividend growth, provide both stability and an additional layer of compounding income. Each component serves a purpose. Some anchor the portfolio, some provide dependable payouts, and others accelerate growth through reinvestment. Diversification reduces risk and smooths returns, ensuring that income remains steady even if one stock underperforms or an industry faces challenges. Calculating the portfolio's average dividend yield across all holdings gives a clear estimate of potential monthly income over time. By averaging yields, growth rates, and historical appreciation, you can project how a consistent small investment grows into meaningful income. The combination of ETFs, dividend growth stocks, and diversification creates a portfolio capable of generating around $1,000 per month in passive income. Importantly, small daily contributions, like $2, play a significant role when compounded with reinvested dividends over decades. The example demonstrates that time and consistency are more powerful than a large initial investment or risky short-term strategies. Anyone can start with tiny contributions, apply discipline, and watch the portfolio grow steadily into substantial, predictable monthly dividend income. Let's project the portfolio over decades to see how small daily contributions accumulate into substantial passive income. Starting with just $2 per day, your total contributions after the first year amount to approximately $730. While that number seems small, it establishes the foundation for long-term growth through reinvestment and compounding effects. After 10 years of consistent contributions, the portfolio could grow to over $15,000, including reinvested dividends. At 20 years, total portfolio value might exceed $80,000, showing how patience dramatically multiplies even tiny daily amounts. By 30 years, the portfolio could reach over $400,000, providing a consistent dividend income far beyond initial expectations. The portfolio would generate roughly $18,000 annually in dividends, equivalent to more than $1,000 per month reliably. These projections combine share price appreciation, dividend reinvestment, and consistent contributions over time to achieve predictable income. Even with modest dividend growth rates and conservative yield assumptions, the portfolio demonstrates the power of disciplined investing. Small daily investments, reinforced by reinvestment and compounding, slowly build wealth without requiring large upfront capital or risky strategies. Diversification ensures that underperformance in one stock or sector does not derail the overall growth and monthly income projections. ETFs provide stability. Growth stocks accelerate returns, and dividend-paying companies deliver predictable income for long-term compounding. Reinvested dividends increase share count automatically, boosting future payouts without additional effort or emotional decision-making. Over time, reinvested payouts create an accelerating cycle, where your income grows even when contributions remain small and consistent. This demonstrates that time and consistency matter far more than a large initial investment or attempts to time the market. Key. Starting early allows compounding to work its magic, turning what seems like an insignificant habit into meaningful long-term wealth. Even small contributions like $2 per day eventually generate thousands of dollars in passive monthly income, rewarding persistence. The portfolio's growth illustrates that the most powerful financial tool is not luck, but consistency applied over decades. Understanding yield, growth rates, reinvestment, and diversification makes investing predictable, manageable, and achievable for anyone. By following this disciplined approach, your $2 per day quietly transform into a portfolio that pays sustainable, growing income reliably. Questo. Now let's discuss key metrics to ensure your dividend portfolio remains safe and sustainable over the long term. Payout ratio tells you what percentage of a company's earnings is paid as dividends, helping gauge sustainability and future growth potential. Companies with payout ratios under 60 or 70% usually have room to maintain and increase dividends over time safely. A payout ratio consistently above 80% can signal risk, meaning the company might struggle to sustain payments. Dividend coverage ratio measures how many times a company's earnings cover its dividend, indicating financial strength and reliability. TOBAT. A coverage ratio of 2 or higher is generally strong, showing the company earns twice what it pays out in dividends. Ratios below 1 indicate the company is paying more in dividends than it earns, which is clearly unsustainable for long-term income. Free cash flow is also crucial, showing the money left after operating expenses and investments to support dividends. Consistent positive cash flow ensures the company can pay dividends even during economic downturns or market volatility. Debt levels impact sustainability, because high leverage can limit a company's ability to maintain or raise dividends responsibly. Generally, a debt-to-equity ratio below 3 is healthy, while anything above 4 can indicate elevated financial risk. Extremely high dividend yields, like 8 to 10%, often signal underlying problems or potential dividend cuts. Understanding these metrics helps investors avoid dividend traps and select companies with stable, reliable long-term income. Diversifying across multiple dividend payers reduces risk while maintaining portfolio growth and smooths monthly income streams. Each company should be evaluated for stability, growth potential, and consistent dividend payments to create a balanced, resilient portfolio. Quiz. Monitoring dividend growth rates ensures your portfolio compounds effectively, increasing income automatically without additional effort. Reinvested dividends magnify growth, allowing your portfolio to accelerate even if initial contributions are modest or incremental. Consistently reviewing metrics prevents surprises, helping you maintain confidence and control over long-term passive income. The combination of careful selection, dividend growth, reinvestment, and diversification maximizes predictable monthly income safely. Following these principles allows even small daily investments, like $2, to generate substantial long-term dividend income reliably. ETO. Now let's explore how the portfolio works in practice, combining dividend-paying stocks and ETFs for consistent growing income. Each component of the portfolio serves a specific role. Some anchor stability, some provide dependable income, and others accelerate long-term growth. Broad market dividend ETFs offer exposure to hundreds of companies, reducing risk while providing steady payouts and long-term appreciation. Dividend-focused ETFs increase income through reliable cash flows, allowing the portfolio to generate meaningful monthly payments consistently. Individual high-growth dividend stocks compound income more rapidly, multiplying returns through consistent dividend increases and reinvestment over time. Brace. Financial sector stocks contribute stability and predictable dividends backed by strong, consistent earnings across multiple market cycles. Real estate investments, particularly logistics and warehouse-focused REITs, provide diversification with tangible assets and growing income streams. Calculating average portfolio yield allows us to estimate monthly income, combining yield, dividend growth, and reinvestment accurately. For example, an average portfolio yield around 3% generates substantial income when dividends are reinvested and contributions remain consistent. Dividend growth over 10 years increases annual income automatically, even without additional capital beyond the initial contributions. Reinvested dividends increase share count, compounding income, and accelerating the portfolio's growth faster than contributions alone. Small daily contributions, like $2, start to accumulate noticeably over time, creating a strong foundation for future income. After 10 years, consistent contributions combined with reinvestment can grow the portfolio to over $15,000, including dividends. At 20 years, total value may reach $80,000, demonstrating the exponential effect of patience, compounding, and reinvestment. By 30 years, the portfolio could exceed $400,000, generating more than $1,000 monthly in dividends reliably. Quarter. These results include both share price appreciation and reinvested dividends, showing the full effect of compounding over decades. Diversification smooths the emotional side of investing, reducing stress while maintaining steady income and long-term confidence. Monitoring key metrics like payout ratio, coverage ratio, cash flow, and debt ensures dividends remain safe and sustainable throughout market cycles. The combination of careful stock selection, ETFs, reinvestment, and diversification creates a robust portfolio that withstands market volatility. Following these principles, even small daily habits like $2 consistently build meaningful, predictable, long-term dividend income. Hindi. After decades of consistent contributions, dividend growth, and reinvestment, even tiny daily habits produce substantial monthly income reliably. Small amounts, like $2 per day, may seem insignificant initially, but become the foundation of financial freedom over time. Compounding multiplies every contribution, turning consistent effort into a growing stream of predictable, long-term dividend income effortlessly. Patience is critical because the largest effects of compounding appear gradually, often after several years or even decades. The earlier you start, the more powerful compounding becomes, allowing small daily investments to grow far beyond initial expectations. Diversification ensures your portfolio remains resilient, smoothing income even when individual stocks or sectors underperform temporarily. Monitoring payout ratios, coverage, cash flow, and debt protects your income while maintaining a balance between stability and growth. Combining ETFs, dividend growth stocks, and consistent contributions creates a portfolio capable of producing over $1,000 per month. Over 30 years, consistent $2 daily contributions could result in a portfolio exceeding $400,000, paying predictable dividends monthly. These results demonstrate that time, consistency, and discipline matter far more than large initial investments or risky short-term strategies. Even small habits applied daily, like contributing $2, can transform your financial future if compounded intelligently over decades. Reinvested dividends accelerate growth automatically, allowing your portfolio to generate increasing income without adding more effort manually. Consistent, disciplined investing ensures long-term success, reducing stress and making financial planning predictable and achievable. This strategy is accessible to anyone, regardless of experience or starting capital, emphasizing patience and small, consistent actions. Remember, the portfolio's success relies on steady contributions, careful selection, reinvestment, and diversification to maximize compounding. Kyoshiri's. By following these principles, your $2 a day habit quietly grows into substantial, sustainable dividend income month after month. The beauty of dividend investing is that it rewards consistency and patience while providing predictable income and long-term growth simultaneously. With small daily investments, intelligent reinvestment, and diversification, you can achieve financial goals that seem impossible at first glance. I encourage you to start today. Remain disciplined and watch as your portfolio grows steadily, creating meaningful income over decades. If you enjoyed this video, like, comment, subscribe, and keep watching for more simple, effective strategies to grow your money.